So let's jump right into an example. This example is for Sahali snacks. Some of you may have encountered them. They're widely available at places like Whole Foods. They were available at Starbucks for a while until Starbucks came up with its own competing house brands. And Sahali designs and makes upscale nut-based snack products. It was co-founded by Josh Schroeder in 2003. He is a Columbia University MBA alumni. He is a friend of mine. We got our MBAs together, and I've worked with Josh and his company on various projects since then. And happily, just started this from scratch and was able to sell it to Smuckers in 2017. So that's a really wonderful success story. Okay, so is Sahali Snacks seasonal? So the answer is no. These snacks are used, they're bought by people year round. They're not a specialty thing like a fruit cake or a small thing of honey for some Jewish holidays, that type of thing. They sales may go up a little bit around holidays, but in general, people aren't buying these for gifts. They're buying them for themselves. So Sahali is not seasonal, and their financial statements bear that out. All right, so let's look at their situation at end of year 20x0. So for us, we're going to, as usual, call that now, although this was actually a little bit in the past when I was working with Sahali to actually do some analysis for them that we're going to repeat here with simpler numbers and stuff like that. So what's the situation? So over the past several years, sales have been growing by about 10%. And you can see that here in the last year, they had about 91 million in sales, up to 100 million in the most recent year. So that puts the sales growth at 10%. And then if we look at everything else here, you see that I did a bunch of ratio analysis for them. Their ratios are relatively stable, so they've had good and growing profit margins. Their COGS margin very high. They're a very high variable cost firm, right? Because for every dollar of sales they make, they have to make another package of nuts. So very high variable cost firm. Okay, and their SGA costs fairly stable as we'd expect. They're not paying much in interest. They're not very levered. We got their tax rate. So their debt to cap, as measured by GAAP, about 20%, staying relatively stable, and their debt to EBIT is greater than 1, so that's good. And you can see here their fixed to variable cost ratio is very low. Again, makes sense for the type of company that they are. Their current ratio, they're selling pretty close to the wind. It's just about 1. So that's kind of interesting, but not the end of the world. So they have, Jamie Dimon would be really happy with these guys. Their EBIT, that's the earnings from operations available to pay interest divided by interest, is 8 or 9 times. So that's looking real good. And we can go through the rest of this stuff here. We've got their pre-tax interest rate, their tax rate, and their cash level. This is used by a lot of CFOs. We didn't focus on it too much in ratio analysis, but they use this as a measure of do they have enough cash on hand. So cash level is cash plus short-term investment over sales, and Sahali's CFO felt like that number needed to be about 5% to make sure they had enough cash on hand at all times. So clearly you can see from this ratio analysis, everything's been pretty stable, jumping around a little bit as of course it's going to do for any company, but really pretty stable, solid firm. All right, so here are their 2 most recent financial statements at the time. So again, the sales grew from about 91 million to 100 million, and the COGS went up pretty much proportionally to that. And again, I've simplified all of these things for us, but the numbers are representative of what was going on at the time. Depreciation is important for them. They do have a lot of equipment to cook these things, to mix them together, to package them. They have delivery trucks, they have warehouses, all that jazz. And so very straightforward income statements. And you can see here their profit has been increasing kind of in line with their sales. Okay. And their balance sheet, relatively straightforward for a small industrial type company. They've got some accounts receivable, and these are growing with their sales, inventory growing with their sales. They've got some other current assets. And we're going to use the finance way of looking at PP. So we'll look at net PPE. That's growing too. The more sales they have, the more machines they have need for cooking these nuts, for mixing them, for packaging them, et cetera, et cetera. and they've got their accounts payable, accrued liabilities, that's unpaid salary and stuff like that. And they've got their other current liabilities. They do have some debt, not too much. They took out a little more debt in the past year, and we add up all their liabilities and we've got their equity there. So very, very straightforward balance sheets, and nothing's jumping up and down in some weird, untoward way that we might not like or might not expect. The other two equations we're going to have to look at, the other two items are subsets of the cash flow statement. That's going to be the PPE roll forward equations for us, and subset of statement of owner's equity, which is going to be our equity roll forward equation. So the way that this one works, our equity roll forward, says that equity beginning of period plus net income minus dividends plus paid in capital, or minus paid in capital if there's a share buyback there, is equal to equity at the end of the period. This is a very fundamental financial accounting equation. It is important that you're familiar with this. So you can see in the most recent year, equity beginning of period was 76.85. Net income for the year, as we saw on the income statement here, was 7.74. Okay, and they paid no dividends in the year, so that's zero. And they did have a bit of a share buyback. They had an investor who wanted to leave. They bought her shares back, so that's fine. And then we just add all these up and we get to their equity at the end of the period for 20x0, and that's exactly what we see here. So this roll forward equation is going to be important for us doing projections. And then the second one that's important, as I said, is the PPE roll forward. And the way that this works is PPE net at the beginning of the period minus depreciation plus CapEx. That's additions to PPE, right? So depreciation is wearing out of PPE. So PPE net beginning minus how much it's worn out plus how much we've added is equal to PPE net end of period. So let's see if we can suss this out for the most recent year. So we've got here PPE beginning of period is always exactly the same as end of period for the prior period. Okay, their depreciation, we're going to see their weighted average life of all their PPE is about 10 years, so they're going to depreciate about 10% of that a year. We'll see that in a bit here. And they also, as they're growing, they target their PPE at the end of the year to be equal to about TTM sales. So we have the beginning here, we have the depreciation, which we'll talk about more. We have their target for where they want their net PPE to be at the end of the year, and that tells them how much CapEx they should be spending during the year to make that all work out. We'll look at the mechanics of this roll forward equation a little more as we go on. So now let's get into doing some real analysis about this. Okay, so just a little tip, if you've been following all the way through up to this point, I'd suggest at this point, notice where the timer is, how far into this video we've gone, and pause the video at this point and go do something else. Take a walk, play some video games, read some wonderful financial information from The Economist or Barron's or something like that. Listen to an episode of Bloomberg Surveillance, and then come on back and we'll continue. Okay, see you soon. All right, so back in action here. So let's think about now what was going on with Sahali at this time. They were at this time when I was working with them, they were clearly a startup company, so they weren't issuing dividends. They were focused on growth and their exit strategy, selling themselves to something like Smucker's at the end of the day. But they're big enough now that the board of directors feels like they can start issuing dividends. And so the board has said that they want to start issuing dividends equal to 15% of net income for the next 2 years. So in terms of our ratio analysis, we would have called that a payout ratio of 15%. So that's all well and good, but the CFO needs to know if this is going to work. So this is really sort of put to as a question to the CFO. Can we do this? What are the consequences if we do this? Okay, so she is concerned, as she should be with any startup, is what's this going to do to their cash position? So her big question about this is if we go ahead with this dividend policy, what's going to be the end of year cash balance for the next 2 years? So that's what we're going to solve for in our projections. She also wants to know, and the board, of course, wants to know how big will the dividends be, estimate, right? What's the projected estimate of how big those dividends will be? And her policy on the question of is the cash level going to be safe is she says, and this is actually common for a lot of companies, she says that the cash level of the firm is safe if it's greater than or equal to 5% of 12 trailing month sales. So that's fairly common, and this is something you'll see, those of you who go on in finance, you'll see it in advanced finance courses and consulting and things like that. And she also would like to see a general ratio analysis for both years. So that's going to be exactly the same type of ratio analysis that we looked at the beginning of the Sahali example. So she has some views, and the firm has some policies for the next 2 years. So we're going to look at this situation with sales continuing to grow at 10%, dividends set at 15% of net income, payout ratio of 15%. Debt to cap has been most recently at 20%, and she would like to maintain that ratio so the firm doesn't get any more or less levered, okay? And as I pointed out briefly before, they feel like they have enough net PPE. Their net PPE has to keep up with their sales because they need more ovens, they need more packaging equipment, they need more warehouse space, they need more trucks, that sort of thing as their sales grow to deliver more and more packages of nut-based snacks. So they feel, based on their experience, that their net PPE is keeping up if it at the end of the year is equal to about 100% of 12 trailing month sales. So that's going to be a target for PPE going forward. And the average depreciable life of all the depreciable assets of the firm is 10 years, which means that the depreciation in each year is going to be 10% of beginning of period net PPE. That's a lot of work she did to, the CFO did to get that number, but happily she did it, so we don't have to. So also, the board has said assume no stock issuances or further buybacks in this 2-year period. And since the leverage ratio is going to be the same, the pre-tax interest rate should stay the same, and they're not going to have any weird accounting changes, so their tax rate will remain the same as well. So now the CFO, given all this information, God help her, has chosen to ask us to help answer all of these questions. So let's go ahead and see if we can do that. So here's how it works. Let's start by looking at some historical formulas and percent sales ratios for Sahali's income statement. So I have the past 2 years here, okay, and I have how they relate to something like percent of sales or something else over in these 2 columns here. So let me show you how it's working here. So I've got sales for the year prior, sales for the most recent year, and the COGS in that year, and the COGS here in this year, okay? And then what I have here is this 68.8% is the COGS divided by sales ratio, okay? So let me just put in that down here. So this is 68.8% is equal to 62.5 over 90.91. And let's also put another star up here. This is one that you can check very quickly. The 68% is equal to 68 over 100. Okay, so these are percent of sales ratios for the year. So COGS was 68.8% of sales a year ago, and in the most recent year, it was 68% of sales. So, and one thing to note just now, I'll talk about this more, but it's remained relatively constant, even though sales went up by about 10%. So as a percent of sales, the cost of goods sold was about the same. Okay, so let's keep going. So depreciation 8 million and change up to 9 million and change. How did that happen? That comes from our CapEx depreciation roll forward equation, which we looked at briefly and we'll look at again. Okay, and SDA is something we don't have a directive for, and we don't have an accounting equation for. So again, this is going to be percent of sales. And let's just put that in here. Okay, so 10.0% is equal to what here? We want to have our SDA of 10 divided by 100. Okay, so that 10%, 10 over 100, our SDA divided by sales in the year, so 10% of sales in year 0. All right, let's keep going. So EBIT is just a subtotal, as we know, and the interest is always RD times BOP debt, and their RD is 7.25%. So in this case, this is a classic case where we do have an accounting formula. Wherever we have an accounting formula, we use that accounting formula. We will use it going forward, okay? And tax, as we know, we have a formula for that too. It's earnings before tax times the tax rate, which for Sahali is 33%. And that's everything. So we just come down and get our net income. So as sales are going up, net income's going up, that's a good thing. So when projecting forward, for the things back here that are in gray, we have an equation to help us project forward, okay, for the stuff in gray. And everything else we're going to say is going to remain at a constant percent of sales. So in other words, in this year, if COGS was 68% of sales, when we project forward into year 1, we're going to say that in year 1, whatever the sales are, COGS is going to be 68% of that. So we're going to project forward based on year 0, not the average of year 0 and year y minus 1. And notice how this works pretty well, even with 10% sales growth. So 68.8 to 68, 10.2 to 10, even though sales grow by 10%, as a percent of sales, SDA and COGS remain relatively constant. And that's very, very common. Okay, this is nothing I've fudged up for us. This happens as long as the future is looking kind of like the past. This holds up extremely well. So let's think about a little bit about the items that we are going to project as percent of sales. So anything that we don't have an accounting formula for, a CFO directive, what we're going to do is we'll say the account value in year 1, that's our first projected year. It's going to be our estimated sales in year 1 times the accounts percent of year 0 sales. So here is, for example, our COGS percent of year 0 sales, that's 68%. Okay, so we would say if we're projecting into year 1 that the COGS in year 1 is going to be whatever the sales in year 1 is times that 68%. Okay, and again, that 68% comes from the year 0% of sales. Formula for percent of sales, just to make it clear what's going on in these two columns. Okay, so I'm saying we should project these things forward based on the year 0 sales. So I know some of you inquiring minds out there might be thinking, well, wouldn't it be better maybe to take the average of the past 2 years percent of sales? And the answer is yes, absolutely. In this case, it would. It might be even better to go back 3 years or 4 years and take the average. But I'm doing it based just on Y0 to keep it simpler for you all, so there are fewer mistakes, fewer work for you, less work for you, and all that jazz. So we're generally going to project ahead to year 1, year 2, year 3 based on what happened in year 0. And that really is just for pedagogic purposes to minimize errors and things like that. So yes, we're just using Y0 only for convenience. There are cases when using just last year's percents would be best, and that would be when industry company, etc., was disrupted. Okay, if we've had a big change in the industry or the company has moved into new markets or something like that, the old company before the disruption happened, all of that stuff just doesn't count. So we just want the most recent year, which represents the company's current state going forward. Okay, also one other thing that's interesting here is we said that SGA projects as percent of sales here. So here's our little SGA. We're going to project it forward as percent of sales. And really that's sort of at odds with our notion that SGA is a fixed cost. So this is not really a great assumption. And as you know, in our models, we have a lot of bad assumptions. Does this conflict with our prior ratio analysis assumptions? Yes, see above. It is, in fact, a fixed cost, okay? And it's okay to have this problem. Why? So SGA, relatively small, okay, expense, and we're not projecting many years forward. And finally, especially if we're consultants doing this work, this would allow us to make improvements in the model as a phase two. So we report to the CFO all this great stuff, and she says, oh, that's really great. And we say, however, we can refine this for you and do better. For example, we can do a good study of where your SGA is going to go and model that in a more sophisticated way than just assuming it's going to grow with sales, which is probably a bad assumption, and et cetera, et cetera. So then we get the phase two contract and we get another $100,000 and we're very happy as consultants. Okay, so let's move on. Okay, so now let's go back and review some of the income statement items that we are going to project based on an accounting formula or a CFO's directive. Those were the things shown in gray back here, here we go, okay. Shown in gray. So let's just go through them, make sure we understand them all. Okay, so depreciation is always, it really has nothing to do with sales. It's always some percent of PPE cost. So we're going to get our depreciation from our PPE depreciation CapEx roll forward equation. All right, so we always want to do that with depreciation. And we'll look at that roll forward equation more carefully in a minute. I'm skipping all the gray pages as usual. Okay, next up, we do have an accounting formula for interest expense. So we're always going to project forward using that. Interest expense is going to be debt at the beginning of the period times that RD interest rate, which is 7.5% for Sahali. You want to get that 7.5% if you don't have it already, including all the debt, all the loans, all the bonds, long-term, short-term. And then next up is income tax expense. We do have an accounting formula for that. Income tax is always earnings before tax times the tax rate, which for Sahali is 33%. And then next up is dividends. Dividends in general are always going to be set by the policy of the board of directors. And they may say they want dividends as a percent of sales, percent of net income, or anything else that they say, okay? And in this case, the board said that they wanted a particular payout ratio. They wanted the payout ratio to be 15%. That translates to 15% of net income, and they want to try that for the next 2 years and see what happens. And then another thing to think about is paid-in capital, and the board and the CFO have said for the next 2 years, assume there's no share issuance and no buybacks. But in general, definitely this is not going to project as a percent of sales because it's a policy set by the board of directors. So that's definitely not going to project as a percent of sales in general.